But the one which is on our radar right now is Bank of Maharashtra. Reported their Q1 numbers yesterday. The asset quality and the net interest margin continue to remain stable. My colleague Abhishek spoke to Nidhu Saxena, the MD and CEO of the bank, and started by asking about the deposit growth. Listen in.
The industry is currently encountering a very intense situation where the credit growth is outpacing the deposit growth in the system. And I'm also not out of the system. Like if you see my numbers, my credit is expanding YOY 19%, whereas deposit I could get at a YOY growth of 10%. But having seen the situation, we are taking a lot of steps on an immediate basis, and some things that we'll be planning to implement in the near term, so that some results will come. So what we are specifically trying to do is what I will try to explain here. We are having good patronage from state government departments, ministries, many institutes in Maharashtra and outside Maharashtra as well. I am able to see some traction in 3 months, and people are responding, and we are getting some green shoots. And I'm only going ahead strengthening this effort. And so this will take care of broadly institutional deposits. At the retail deposit level, we are doing a couple of measures. I have seen that powerful digital channel is mobile banking. So we are working on making digital banking more customer friendly. And in fact, going forward 6 months to 9 months from now, there'll be a lifestyle banking application that we are launching, which will be a new version providing additional services.
Sure, sir. Now, you spoke about, loan growth outpacing the deposit growth. We have seen that for the banking system as a whole since April of 2022. Now, credit growth has outpaced the deposit growth. Talking about your own credit growth, how has it been segmentally? Where are you seeing demand from? And by when do you expect, the proper capex cycle in the corporate portfolio to come back?
Yeah, Abhishek, that's a good answer. The good question from your side. We are also trying to find answers because we have been discussing this, we've been hearing this. And yes, the private capex cycle in true sense is yet to be seen, maybe next 2 to 3 quarters. We expect that demand coming from the corporate, and I see that manufacturing sector has to really come up, and for capex in the private sector, it is still something which we'll be awaiting, and maybe next 2 to 3 quarters. But other than that, we are seeing a lot of traction in the RAM segment. Our retail, agri, MSME, they are having healthy double-digit growth.
While net interest margin has remained healthy on a sequential basis, we are in a rising cost of deposits or cost of funds scenario. And, I'm still waiting for your answer, whether you have heard from RBI with respect to credit deposit ratio at 75%. So how do you see, net interest margin panning out ahead if at all you have to put your CD ratio, that is credit to deposit ratio, at 75%?
So let me just clarify, Abhishek, here. There is no regulatory prescription on the CD ratio as such. But yes, the regulator is watching this parameter, how it is moving. And from 75, we are now at 78.16. And I think that's a healthy ratio, 78, 79, we would like to maintain to see that my net interest income is going up. So there is no discomfort to me in maintaining a CD ratio of around 78 to 80 between. I don't think so there's a problem there. And yes, deposit, as you said, I already explained a lot of, to fuel this credit growth, we require a lot of resources. And currently, although if you look at my capital adequacy, we are at a comfortable zone. But I have my plans in place. We are also exploring raising for my infrastructure book that I am having around 27,000 crores. So I will be going to board very shortly, and we will try to do one tranche of raise through infra bonds also. So where we get the advantage of CRR, SLR requirements are not there, and my cost of borrowing also will come down, is what the sense is coming to me. So we will explore that option too.
So what is the guidance on net interest margin trajectory?
So we are keeping a guidance for ourselves of maintaining a NIM between 3.75 to 3.9. Although I'm doing 3.97 for the last 2 quarters, I don't see much of challenges, but I want to be conservative here and keep a guidance of 3.75 to 3.9.
Well, that's very good, sir. Now, slippages marginally increased on a sequential basis, which is seasonal in nature, but your credit cost spiked up. So, provisions for NPA spiked up by 28% on a sequential basis. What was this provision for, and how do you see the outlook with respect to slippages and credit costs going ahead?
Yeah. So let me clarify here, Abhishek. The issue is that I am already an NPA of at 0.2%, and I'm maintaining that level. So whenever I'm encountering any slippage, I am required to provide more than the regulatory prescription, and I am doing above that. So if you look at credit cost, as per the IRAC norms, it works out to only 0.4%. And yes, the credit cost for June has been 1.12, which is on Q&Q sequential basis has gone up. But this is on account of slippages in the agri segment, which is, I think, not something we are not able to control. We have seen this trend in Maharashtra in previous years too. And going forward, I'll be definitely able to control this. We will be able to even recover and upgrade a lot of agriculture accounts that have slipped in this Q1, and that also will be able to rectify the position.
Well, what I've observed with bankers are that agri portfolio has been hurting for last 2 quarters in a row, Q4 as well as Q1. And what I'm seeing on the NBFC side, the MFI portfolio is hurting them over the last 2 quarters and is expected to hurt going ahead. So do you foresee pain in the rural economy that started to kick in because of high inflation? And how do you see your gross NPA and net NPA levels by end of FY25?
Okay, so yes, see, we have done at our level certain changes. What we have done is we have changed our focus when we look at the agri segment from the production credit to investment credit. If we all have read about a good monsoon this year. So if the rainfall is adequate, I'm sure the sector will not going forward see any much of stress, and prospects will only improve going forward.